When investors are looking at the most complete set of data available, it becomes fairly clear that value-styled equity funds have beaten growth-oriented funds over time. Still, financial pundits like to debate about value versus growth, typically over much shorter and relatively tamer periods when investment sentiment for stocks is strong. And to be fair, growth has shown a tendency in the past to pop very strongly, creating a sense of missing out or even bigger gains for investors who tilt their portfolios to value stocks. Fortunately, we have a noted researcher in the field, Michael Humbert, here today to provide us with a broader perspective. Michael is an investment strategist at Dimensional Fund Advisors. Hi, Michael. Thanks for taking the time to talk to us today about such an intriguing topic.
Thanks for having me, Murray.
First, let's define exactly what we're talking about here. What do we mean when IFA's wealth advisors and Dimensional's researchers discuss value and growth stocks?
Yeah. When we talk about these designations like value and growth, we are trying to organize information and learn something about future expected returns. And so, to that effort, what we will do is we will take prices of these stocks and we'll scale them by some fundamental variable. We use book equity, but there are lots of fundamental accounting variables to use. This gives us a
PEs, like PE ratios.
Exactly right. PE ratio, very common. You'll see that in the news every single time. But you can use sales, you can use net income, you can use a lot of different information on the accounting. You can use assets. There's a lot of information you can use. What you want to do is you want to scale prices which contain information about the future, about future expected returns, and then that gives you something that you can use to compare across stocks. It gives you a relative price. And what we find is that those securities that have lower relative prices, we're going to call those the value stocks, and those that have the higher relative prices, the ones that you pay incrementally more for, those are the growth side of the market.
Okay. And historically, value stocks have outperformed growth stocks in the US going back to, I think, as far back as 1927. I think you've put out research that, roughly speaking, average outperformance of value for all years going back that amount of time is roughly around 4% or more.
That's right. We've got the luxury of almost 100 years of data in the US. And when we look at the performance on a year by year basis, we see that those value stocks, they have outperformed over the long term. And think about what we're saying when we say that value stocks are outperforming. We're saying that those stocks where you pay less for and get the same amount of cash flow, that you have a better investment experience. You have a better return. It's a very intuitive and evergreen concept, right? The price you pay for something, it matters. All things being equal, if I can pay less, I'll have a better investment experience overall.
Yeah. And so it's logic and history support a commitment to value stocks so investors can be positioned to take part when those shares outperform in the future, which history shows us is a pretty strong trend.
I think that word that you chose, commitment, is very appropriate here because we expect the value premium to be positive. The logic, the intuition, the evidence is there. But we know in realization that equities, they're volatile. In realization, there are going to be periods where value stocks underperform. Our most recent past 5 years has been a historically great performance environment for those growth side of the market there. It's been a historically bad premium environment for those value stocks. But a commitment to value has been shown to pay off over the long run, over that 100-year sample. As we know that those value stocks, when they do show up, they can show up suddenly and in great magnitude, and really just from a subset of stocks. So you really want to be broadly diversified, own the value segment of the universe there, and stay in your seat, maintain that commitment to value.
Okay. Well, thank you very much for your time today.
Thank you for having me.